Hey everybody, this is Jamin Kirkwood from Secure Financial Management coming to you with our special Thanksgiving version of our economic update. Now, in this update, we'll talk about some of the issues that affected the markets in the last couple of weeks and what they might mean to you as an investor. Now, please stay tuned to the end for a required disclosure statement. Well, the first thing we noticed in the last couple of weeks is the incredible lack of volatility that's been in the stock market. And it's actually so incredible that over the last 60 days or so, there hasn't been a 1% or greater move up or down in the markets. And this indicates that there's not a whole lot of trading volume or rebalancing or buying or selling going on in the markets. Now, that ran for a period of 60 days, and that was over last Thursday. We had a movement of more than 1% in the markets, but there still hasn't been, even though that 1% trend was broken, there still hasn't been a whole lot of movement going on in the markets. And it hasn't been a lot of news, positive or negative, really, to move it up or down. Now, what broke that trend was some concern about the new tax plan that Congress is trying to get passed. Now, obviously, you've probably heard about this in the news. There's different tax brackets, and a big portion of it is related to corporate taxes. Now, of course, the corporations and therefore Wall Street like to hear about possible lower taxes on them. There was some concern that, maybe that wouldn't get passed, maybe it wasn't as realistic, which was really what broke that 1% trend and caused the market to move out of that range. Now, outside of that, there's still quite a lot of good economic indicators going on that are supporting the markets, and two of them that I'll point out to you are unemployment. Unemployment remains to be extremely low, down in the low 4% range, meaning basically if you want a job, you can find a job doing something, because there's also something called a natural rate of unemployment that economists talk about. And a natural rate of unemployment, different economists say it's different rates, but a lot of them say that the natural rate of unemployment is about 4% anyway. And what they mean by that is that there's always going to be people between jobs looking to change careers, moving around the country, whatever it might be. So that 4% rate of unemployment is just what's going to happen anyway, kind of indicating that everybody is almost employed who wants a job. So the fact that if you want a job, you can get a job, it's easy to change careers as well. That helps the economy, knowing that there's people out there that have money to spend. And even an economic indicator that we call personal income that hasn't risen in quite some time, even that's starting to trend up as well. So there's quite a few things that are giving the economy stability and support. So even though we saw that 1% trend continue for a while, there's not a lot of movement up or down, and then we saw that broken last week with the concerns around the tax plan that I was speaking to you about, there's still a lot of underlying economic support in the markets. Now, one other thing I want to talk about as far as support for the markets, where's money going, and the reason I spend time talking about this is, from a lot of my clients, I've had emails, phone calls, and questions in general about, look, the markets are so high right now, right? Is it time to get out? Should we rebalance? Should we become more conservative? And those are always valid questions. But one of the big things you want to look at also is, if money is not invested in the markets, where else is it going to go? Because a lot of you know we're in a very, very low interest rate environment right now, and I've discussed this with many of you quite often. You go to the bank, what are you getting paid in your savings account? Almost nothing. What are you getting in a money market account? Almost nothing. CDs aren't much better. And those are all byproducts or results of the Federal Reserve having a low interest rate policy. Now, when interest rates are low, it kind of pushes money out into things that they may not usually invest in, typically things like the stock market, because people don't want to keep money in their savings account making 0.1%. So that drives money towards the stock market. And even though we've been in a low interest rate environment for a long time, and the Fed is starting to move more into a rising interest rate environment, it's not happening very quickly. Right, so is there going to be money pouring out of the stock market back into savings accounts, back into CDs, back into money markets? I mean, I can't tell you the answer for sure, but the interest rate environment hasn't changed that much. And as of today, even if we look at some of the treasury bills and treasury notes that you can invest in, a 10-year treasury bill or note will pay you, as of today, about 2.35%. Do you or anybody else want to tie up your money for 10 years to earn 2.35%? There's not a lot of people I know that are going to do that. A 30-year note will pay you 2.79%. there's not a lot of people I know that will invest their money for 30 years to get paid 2.79%. So these are some of the fundamentals that we look at as far as where we should be putting client money. Should we be in equity? Should we be in bonds? Should we be domestic? Should we be overseas? Should we be emerging markets? And look at the general trend for the market. And that's one of the things that we're focusing on a lot right now is what's happening with unemployment. It's pretty good. What's happening with personal income? It's starting to rise. Are interest rates going up? Yes, but very slowly. And we're still not in an environment where you can go out and buy a 10-year treasury note or go to a CD in a bank and get 4, 5, 6% like you used to. We're not there yet, and the trend we're on doesn't look like it's going to be there anytime soon. So those are just a few of my thoughts that I want to share with you guys as to what's been happening in the last couple of weeks and what we're looking at for clients as far as building out our investment portfolios. So it's important to remember that nothing we discuss here should be taken as an investment recommendation. If you'd like to discuss your personal financial situation, please give us a call here at the office at 210-428-6250. We'd be very happy to speak with you. I also want to wish you all a very happy holiday season and a great Thanksgiving next week. Talk to you soon.